Good afternoon, everyone, and welcome to Prestige Wealth Management Group's first quarter 2024 economic and financial markets update. On today's webcast, you're going to hear from Prestige Wealth Management CEO Roy Williams, Senior Portfolio Manager Paul Esposito, and Wealth Advisor John D'Angelo. A couple housekeeping items. Just please note we cannot take any live questions during today's webcast, but if you do have any questions, please send them in to pwm@prestigewmg.com, and we'll be sure to get back to you and answer them. With that, I'm going to pass it over to Paul Esposito to kick things off.
Michael, thank you very much. Good morning, everyone. The first quarter was, I would have to say, very surprising given some of the dialing back of the rate cut expectations by the Fed. I mean, I think that is predominantly what drove market movement from the fourth quarter into the first quarter of this year on, what a lot of individuals believe to be some frothier valuations. But, despite the Fed going from somewhere at, the expectation being somewhere around 4 cuts for this year to now somewhere between 2 and 3, if that, the fact that markets have remained this resilient is quite astounding. I mean, so for the quarter, you had almost a 10% return in the S&P 500. The NASDAQ and the Dow were very close to follow there. Bonds, on the other hand, fairly lackluster returns. Were down slightly for the quarter. But again, despite the interest rate adjustment, the volatility due to the expectation of the Fed reducing its rate cut outlook, all in all, a very good quarter. Now, what's going on underneath the hood, I guess, is the primary concern, right? Because the markets right now have just been on this, this path to digesting Fed language, and that's predominantly been moving markets. But the overall health of the economy does need to be taken into consideration. And when we look at the globe, this is really a composite of both manufacturing and services PMI. And it's a good leading index to basically tell us what the state of the global and/or country-based economies are on a leading basis. So if we look at the globe, the light green is indicating any prints above 50 show that we're in an expansionary regime. Anything below 50 shows that we're contracting. So on a global basis for February and March, that trend was positive when we combine both manufacturing and services. Obviously, most of the world is, at least most of the developed world, is predominantly service-based. So that's going to have a heavier influence. The manufacturing side has started to weaken, and really the culprits there are the euro area. If you look at Germany, France, Italy in particular, you look at those PMI readings, they're really starting to get noticeably below 50. For March, the adjusted numbers for both service and manufacturing in the U.S. stood at about 51.5 and 50.3 respectively. And the expectation when we get May's reading for April is that the manufacturing will still be around 52, and services will be around 52, and manufacturing should still be around 50. So, overall, when we look at that heat map in 2022 into 2023 showing, broadly more weakness in economic conditions, we're now finally starting to see an improvement. Looking at the unemployment situation in the U.S., I mean, that is probably, the note of strength for the U.S. economy and continues to be for this business cycle. It is a very low unemployment rate. The March figure actually printing at, a 3.8% level of unemployment. And we look at the jobs gains for both February and March. February was at, I think, about 270,000. March was at a 303,000 job gain print. Very, very attractive. However, if we really delve and get deep into the weeds on the composition, there is a little concern. One is in wage growth. That component has pretty much gone nowhere. And if you look at how supposedly tight the labor market is, one would expect that we would start to see at least a better uptick in wage growth. And that's been, a point of contention for consumers, right? If your wages are not going up at the pace that at least inflation has been, or is at least outpacing inflation, then, the misery index is still, not as benign for those individuals. But, if we start looking at the quality of jobs in the most recent March report, that was something that was a little concerning. Again, I don't think it's anything to panic over, but of that, 300,000 plus jobs print, there were a considerable number of part-time jobs in that composition. So given, we could be at later stage in this economic cycle, it is something to, be very cautious about. So the inflation picture, obviously, that's sort of what set markets, into a bit of a pullback just in the past week when we got the most recent March figures for annual CPI. Instead of the 3.2, and again, I apologize, we have to do these charts in advance for compliance, so some of this stuff tends to be a little dated as a 4.8 as opposed to today. But as of the March print for inflation, we were at 3.5%. It's noticeably above the target inflation rate for where the Fed is. Fed's targeting 2. Core PCE is probably somewhere closer to 2.5%. So the Fed is still trying its hardest to bring inflation down to a reasonable level. And then if we look below and sort of where we rank in our CPI versus our counterparts, Europe, Japan, and the UK, we're not as low on a disinflationary trend as say Europe, which again, given their recessionary concerns, that kind of comes hand in hand. But we're also, not trending the way Japan is, right? Which I think it's very evident that they have some stickier high inflation. So, as we start to get more inflation data and expectations are adjusted, hopefully we will start to see, some, the inflation data closer to that, the Fed's long-term target. If it does, I think if we're within, a 0.25% to 0.5% within that target range, it very well may give the Fed justification to do 2 cuts potentially in the second half of this year. But when we look at inflation and the components of inflation, now these charts go up just till the end of January. So if you look at the chart to the left, you're seeing just your overall headline CPI number, which is goods and services. It includes energy. Obviously, in February and March, if we were to extend that chart, energy, the uptick in energy would have created a higher uptick in the CPI, which it did. The same thing with shelter costs. Shelter costs did go up about 6% on a year-over-year basis as well. Those tend to be the larger components of CPI. But interestingly enough, if we kind of take out, if we look at core services and exclude shelter in the CPI figure, very interesting trend that we've seen in auto insurance premiums going up drastically as a percentage of that overall composition. So, if we always usually recommend here at the firm every 2 to 3 years to kind of review your auto policy just to see if you can save on premiums. But I think part of the conundrum there is with a lot of the newer EVs having higher cost structure, obviously pushing that up. But all businesses, I should say, are guilty of, trying to pass on costs to consumers, especially insurance companies. So when we look at the overall health of the economy and I think where the direction is, where it has gone over the last year to where we're at present, I like using the Conference Board's leading economic index. So it's a composition of 10 notable leading economic indicators, from hours worked in manufacturing, stock prices, to credit, to consumer expectations. And I think it gives us a very good representation of the state of the U.S. economy. Now, if we look at the trailing 6 months and trailing 12-month trends, and that blue line, that year-over-year change, it has been negative. And it was all the way leading up until just the start of this year. Now, we're still in the negative territory, but as you can notice, things are getting less negative. There's a bit of an uptrend that we are starting to see. Most notably for last quarter, there was considerable strength in weekly hours worked for manufacturing jobs. Of course, stock prices are a leading economic indicator, and with the S&P reaching new all-time highs, along with the other indexes, that was certainly a positive. And then credit indexes have certainly relaxed. And then finally, residential construction actually had an uptick in the earlier part of the quarter. But the flip side of that is there is some weakness, most notably in new orders. So, especially for durable goods, haven't really recovered to, I'd say the immediate post-pandemic era, supply shortage levels, and then also consumer expectations. But as those adjust, I think that, very well could, provide some additional lift as we resolve those figures later in the year. Again, they still remain a risk to markets. I mean, market sentiment is certainly what drives price. So that's something that we'll be very keen to look at in this quarter and the subsequent quarters for the year. And with that, I'm going to hand over to John to discuss the Fed's rate policy.
Thanks, Paul. First chart that we're looking at here, from back in February, I think is very indicative of we think about last quarter's call and we get back to Q4. The Fed got to a pivot point, I'd say, at the end of October, early November, where language had changed and the Fed was starting to talk about no longer raising interest rates, and they started the discussion of when they would begin to cut interest rates. We saw asset prices react to that quite strongly through fourth quarter and certainly the early part of this year, as Paul's eloquently discussed. And if you look at this chart as of February, I think the markets had a very optimistic viewpoint on how many rate cuts the Fed was looking to get in this year. So the prediction was for 4 cuts in 2024. The probability for those cuts were pretty high, I would say, on a monthly basis. So I think the view of let's say, probably when you think about it from a market perspective, is that there was a lot of tailwinds for assets and asset prices that were coming with these rate cuts, and that was certainly reflected in stock prices and valuations. If we move now toward today, and the Fed and interest rates, one of the things that we found through some of the reporting earlier this month, and then of course we had some other things go on, is that inflation has been a little bit stickier than anticipated. The probability of rate cuts now has went from 4 rate cuts down to about 2 rate cuts. And I think the big worry that Chairman Powell and when we think of the Federal Reserve, their big concern is making a policy mistake. Do they cut rates too much, too quickly, and create a bigger problem, similar to back in the 1980s? So I think that the Fed is started to posture towards some caution, and for good reason. We think of the conflict in Israel and Iran. That's caused some input prices, oil prices, to rise, which is, which could lead to stronger inflation. The Biden administration recently came out with a recommendation to triple steel tariffs on China. That could also be inflationary. So the Fed is kind of, balancing some of these policy decisions, with rate decisions. And I think right now, what we're looking at is potentially the first rate cut maybe coming a little bit later in September versus earlier, and potentially being a little bit, less through the end of the year, and even some possibility of no rate cuts until 2025. I think Bank of America just came out the other day with discussing risks of potentially the first rate cut not coming till next year. That kind of brings us to, talking a little bit about valuation and earnings. There's a little bit of a different chart than we normally use on valuation when we think of the S&P 500. If you look at the chart to the left, we're extrapolating, the top 10 stocks, which really is mostly what they call like the Magnificent Seven stocks, these ultra mega cap technology and communication services stocks from the rest of the S&P 500. And it tells 2 stories. One, we think of like machine learning and artificial intelligence. These companies have certainly begun to trade at a premium and a premium valuation to the rest of the market. You're looking at 29 times earnings for the top 10, probably a little bit higher than 29 when we just consider the Magnificent Seven stocks, these ultra large cap tech stocks. But if you look at the rest of the market, the rest of the market's not nearly as expensive. It's probably more along the lines of being fairly priced, and there's an argument for some sectors of the market being actually exuding value. And it's also important to note that now the weight of these stocks, these Magnificent Seven stocks, have become a pretty large percentage of the index, and they tend to drag some of these numbers with them. So when you think about components like valuation and you start thinking about components like earnings, a good amount of it is baked in the cake in these larger, I'll call them mega cap stocks. So if we move to the next chart, and we start looking, I'd say, a little bit deeper into these companies and the rest of the market. This is kind of the why, right? Why in the world are these stocks trading at this premium valuation? Well, they're trading at a premium valuation because if you look at earnings and earnings growth, the green part of the chart being the Magnificent Seven and the blue part of the chart being everyone else, you can see that there's a big premium, not only in returns, but also a premium in earnings growth from these companies that has come with this new potential industry that I think the markets are trying to figure out. I think an encouraging part of this, though, is also that if you look toward the back end of the earnings growth chart, is that the rest of the market starts to actually potentially come come back in line with some of these companies when we start looking at a forward view of earnings. So that may be an argument that some of the market is cheap on a relative basis and investable. So if we look at the next chart, we wanted to include this because we wanted to talk a little bit about why we've got an overweight, to large, domestic equity versus small cap stocks. And I think one of the things that we wanted to take note of was just looking at profitability or unprofitable companies and debt ratios of some of these companies in relation to these large cap stocks versus small cap. And if you look at the charts on the right, blue being small, with the gray being large, you can see that there is a much smaller percentage of unprofitable companies when we think of large versus small. And in fact, there's a lot less debt that these larger companies are holding. And we think that justifies the large cap overweight that we've had. And from a performance standpoint, I'd say over the last few years, we've certainly captured better performance overall for clients by having a little bit more of a tilt toward large cap versus mid cap through the past few years. With that, I'm going to pass it over to Roy to talk a little bit about our fixed income.
Yeah, just one other comment in terms of the equities. By excluding international and emerging markets, it's been a huge win for our equity portfolios, because since 2020, when we dropped international and emerging markets from the portfolio, the U.S. has, I think it's, Paul, almost double digits outperformed foreign markets, close to that.
Definitely on the emerging market front.
Yeah, it's very significant outperformance. So I just wanted to comment on that. Thanks, John.
Sure.
In terms of fixed income markets, it's funny how people feel about bonds. But bonds, when we look at bonds, it's not just we're getting yield for income that comes into the portfolio. When you get distributions, we probably have 40% of our clients taking monthly distributions. And that helps in terms of stability of the portfolio, providing distributions. And now we're getting real yields. We're getting real yields from the fixed income. When we look at, 2-year treasury at 4.59, now it's even better than that. We've been buying for clients who have cash. One client had cash in the bank, and I think he told me his income was very low. And now they're going to have almost $30,000 of income because they have a lot of cash just from us buying treasuries for them and CDs and helping them out. So if you do have a large amount of cash, make sure to call John, Michael, or myself to help you with that. But yeah, so the U.S. aggregate last year, when we, as John pointed out in October, as we headed in October where things turned around, when the Fed changed their stance on interest rates, the bond index was down right around 3%. And a swing like that in a quarter, it's almost unprecedented to have that kind of swing in a quarter of, we end up positive over 5%. So it's significant, and again, and equities were only up a couple of percentage points at that point, because the market just kept retracing all their gains for the year. So, again, you can't predict markets. The Fed, will make a move. The concern that John and Paul spoke about regarding inflation is very real, and that will drive, some of the fixed income market. But the good news is from here, when they started in 22 raising rates, we're starting at a very low point. Here, at least, we're having yields of 4 to 5% in the portfolio. In some sectors, even higher. And this talks about the fixed income market volatility. Normally, on average, there's a 3.5% intra-year drop in fixed income because things happen. Things happen. You know, the good news is the economy's good overall. You know, we're all being hit with high inflation, but overall the economy is good. Jobs are abundant for most people. And I say for most people because there are certain jobs in certain sectors that have been hurt because jobs have transitioned away from certain sectors. So it's, you know, it's important when we look at the volatility, you know, like I discussed, you know, last year was a 7% swing during the year in the bond market, which is huge. So right now we started the year where our bond market is down. You know, our portfolio is doing a lot better than the index, but still, you know, it's down a little bit for the year. But we rebalanced. You know, we took some money out of the technology stocks, out of growth stocks. We made changes in the portfolio. We did that in February, and we rebalanced the portfolios, just as we did, which I'll talk about in a little while, in 22. Now, importance of rebalancing. If you don't rebalance in 09, if you're a 50-50 portfolio, then you went to 31, then you know, you went from 31 to 50 to, you know, stocks kept increasing to the point where you're over 80%. And the problem with that is if you don't rebalance, it may look good on paper. If you don't rebalance when we have drawdowns, such as March of 09, where the bottom was the Dow, I think it was below 6,000 at that point. We've come a long way since then. If you don't rebalance and take an opportunity to buy, as we did in summer of 22, we bought, which, you know, is uncomfortable for most people because you're buying when the market's down. We took money out of bonds and bought stocks, which worked out. In the end, we may have not done it at the bottom, but it worked out very well for our clients. And in February, we rebalanced again. It's important to maintain a level of risk because if we have to sell stocks when the market's down 20% or 40% or 50%, that money never has an opportunity to come back again. So that's why rebalancing is very important, and we take it seriously for our clients' portfolios. And again, this slide really talks about the importance of rebalancing. You know, what happens without rebalancing, what your equity exposure becomes, and you know, and what happens also in a bond portfolio without rebalancing. So it's important to rebalance, which we do during the year. And we do make structural changes, like we reduced our growth exposure because we felt growth was getting overvalued. So we do make changes in the portfolio besides the rebalancing, but I think it's a very, very important part of what we do in helping clients maintain their wealth. One other thing I want to bring up, a piece of great news, not good news, great news. The government extended again. We got the notice yesterday that if you inherited an IRA from a parent who passed away since 2020, you don't have to take a minimum distribution next year, in 2024, I'm sorry, in 2024. So to me, you know, I want to end on great news because, yeah, the markets are up a little bit this year, and it's been a tough 2 weeks. But again, in the end, I think by managing the way we do, we'll come out on top, and we'll continue to do what we do. Everybody, we'll talk soon.
All right. We want to thank everyone for joining us today for our webcast. Just as a reminder, you will receive a replay of today's webcast in an email, so be on the lookout for that. And if you have any other additional questions, please feel free to reach out to us at pwm@prestigewmg.com, and we'll be sure to get back to you. Thank you, everyone.